Welcome back. My name is Chris Gosselin from Australian Fund Monitors. We often speak to our next guest, Simone Haslinger, the CEO of East Coast Capital Management. Simone, welcome back.
Thanks, Chris.
Tell us what's been happening, apart from the fact that I think you produced 31.7% to be absolutely accurate to the 12 months to the end of June. Well done. And you also came out in the top 10 of our alternatives review. So congratulations on that. But how did it come about? Where did you make the gains? Where did you lose? What did you see during the year?
Yes, thank you. Well, FY26 was quite an extraordinary year. And it was a year in which we saw a number of mega trends, and we were able to take advantage and sort of exploit those mega trends that took place. If you think back in the first half of the financial year, the second half of last calendar year, precious metals was all the rage. Everyone was talking about the gold price and the silver price. And of course, as a trend following manager, we took advantage of that thematic as well. And you and I have previously discussed how precious metals had been on our agenda for the last couple of years, really. So we had the advantage of precious metals as a very strong trend in the first half of the financial year. And then, of course, equities have been a big thematic, whilst the ASX 200 has been fairly anemic and I think returned in the order of 6% on a total return basis last financial year. We do have exposure to international equity indices in our fund. And so we were able to take advantage of that technology-led AI-related thematic that came through last financial year through North Asian markets such as the Kospi, the Taiwanese market, the Nikkei, for instance, but also the Nasdaq and the S&P 500. And then more recently, at the start of this year, we had energy exposure coming into the escalation of the Iran conflict with the United States. So a number of factors contributing to an excellent financial year result for us.
Did anything not work? Or were you just able to benefit from those trends and stay on those trends?
Look, so of course, with what we know in our data is that we don't always pick the trends perfectly. And there were, of course, through the course of the year, a number of positions that looked promising and then ultimately didn't realise. The other thing that we had to navigate, of course, was volatility. And, I think in recent weeks in particular, people would be well aware that the Kospi, whilst it performed incredibly strongly last quarter, at the beginning of this quarter through the month of July, the Kospi's taken a lot of headlines, having pulled back very dramatically. So, of course, with our systems, whilst we can take advantage of these mega trends, we do need to navigate them carefully because they can have very volatile underlying markets.
You recently referenced an article that I found quite interesting, and this concept of looking back and investing forward. Can you just explain that?
We are very fascinated by behavioural finance. We think that underpins why trend following works fundamentally, the way in which humans engage with markets. And so we're always interested in the latest research and what professors at universities are writing on that relates to how humans behave and interact with markets. There's some research out of Ulrike Malmendia, and she's reported on the experience effect. So her core finding is essentially that investors form beliefs about markets based on their own experience, not just data and research. And they heavily weight what they live through. So essentially, a person who has lived through only bull markets is much more likely to invest in equities throughout their lives. And someone who's experienced firsthand a downturn in equity markets is far less likely to be invested or remain underinvested in equity markets throughout their lifetime. So it's not just that. Essentially, her point is that self-awareness doesn't really fix this behavioural bias that people bring to markets. So you may be well aware that your personal history tells you something and you might try to correct for that, but the data tells us that people who have that experience will continue to behave based on what they've lived through. So they'll be their decision making will be informed by the experience that they've had personally, notwithstanding they're aware that this effect even exists.
So the old saying, for instance, of once bitten, twice shy, if you've been through the GFC or a big pullback, tends to infect you or affect you going forward.
Yes, that's exactly right. And so you can miss out on opportunities if you've had that negative experience at some point in your lifetime, but equally you can be over bullish if you've never experienced a bear market in your lifetime as well. And so we always find this research fascinating because it does inform why systematic trend following and a systematic approach to tackling markets gives you an edge and helps you course correct for those biases that just creep into how our brains engage with markets.
Sure, and I guess it probably also explains why even after a pullback like the GFC or any other really large correction, after a few years, a new set of investors come through who've only seen the rebound.
Yes, that's right. It's how these sorts of mistakes keep repeating themselves.
Trend following, which is systematic, tends to just look at the numbers and let the numbers do the talking rather than the emotions.
Exactly right. And so it gives us a mechanism by which we can trade market bubbles, for instance. When others who've lived through a financial crisis might say, equity valuations look pretty full, as, people could very readily have said for the last 2 years, essentially, but given up on a lot of gains if they took that attitude. Systematic trend following gives us a methodology by which we can trade bubbles, knowing that we have built-in risk management into our systems that will tell us when that trend is corrected and it's time to exit. So, it really gives us a methodology and an unbiased, dispassionate way to trade bull and bear markets.
So I guess, we often ask fund managers in these interviews what they see going forward and what do they foresee in the markets. And your reaction is the numbers will tell me, the trends will tell me, and whatever it throws at us, we'll hopefully manage to navigate it.
Yes, exactly. But I will say that in my travels and speaking with investors, we are seeing an increase in investors having some nervousness about where markets are at the moment. Obviously, equity valuations have felt full for quite some time. Geopolitics continues to be a concern. Inflationary pressures continue to be a concern. And of course, you've got this inherent tension for central banks between data indicating that rates probably should go higher, but yet there's a lot of political pressure to keep rates low. So we are experiencing market conditions that may well lead to some dislocation. I think there's an increasing sense amongst the investors we speak with who are starting to think about their portfolio construction and do they have sufficiently uncorrelated exposures in their portfolios to help insulate them in the event that markets dislocate from here, and do they have the potential to access different underlying return drivers from traditional assets. So, for example, if we enter into a continued inflationary environment or a stagflation, do you have the ability to access markets like commodities that will behave differently to equities and bonds, for instance?
You see the potential for tension in various areas, in various markets. Does that allow you to ignore your signals to a degree, or is it purely quant and trend following?
So our approach is purely systematic. The only real influence we have is in how we construct the universe of assets that are available for us to trade systematically. So we have deliberately constructed, we trade over 90 international futures markets currently. We've deliberately constructed an investable universe that gives us a very heavy skew to commodities. And that's because we really see very different return drivers underpinning each of those commodities. If you think about energy markets versus agricultural commodities or precious metals, these are markets that are driven by very different things, often weather-related, geopolitics in some cases, inflation. There's all different things that drive these different markets. What we're very cognizant of is that most investors are very heavily allocated to equities and property in Australia, and in some cases to bonds. And to the extent that they have diversification, that diversification tends to be into things that have different names, but perhaps still have the same return drivers. So if you think about venture capital, private equity, private credit, they are still, in the event of a market distress or dislocation, still highly correlated to equities and bonds in different ways, of course. And, depending on the time horizon that you look at, they can look like they're not particularly correlated. But when a market stressor occurs, they may well become correlated. So we've deliberately tried to skew a portfolio and use, the discretion that we do have is to construct a portfolio or an investable universe that gives us access to as many different return drivers as possible.
Simone, always good to talk to you. 31% last year. Well done. In the top 3 or 4 funds in your peer group over 1, 3 and 5 years. You're just coming up to 7 years, I gather, in December.
Yes.
We'll look forward to speaking to you again soon.
Thanks very much, Chris.